The U.S. market is closed for the weekend, but the conversation around Chime Financial, ticker CHYM, is anything but. We finished Friday's session, November 7th, at 20.34 a share. That's a gain of $2.25 on the day, a massive 12.44% surge. And it didn't stop there. After-hours trading added on another 26 cents, or 1.28%. This move is the reason we're talking, because for months, the expectation for Chime was that of a broken IPO, a poster child for the fintech crash. The reality, however, is that this 12.44% jump wasn't a random spike. It wasn't a baseless meme stock rally. This was the market violently repricing its expectations. This was a direct, if slightly delayed, reaction to the fundamental data the company dropped just 2 days prior. The common belief was that Chime was another cash-burning neobank, a $25 billion private valuation dream that had turned into a public market nightmare. But the reality, as confirmed by this week's blockbuster third-quarter earnings report, is that the business model is working. The market, which had left this stock for dead, is suddenly realizing it might have made a huge mistake. Let's look at Friday's trading action because it tells the story. The stock closed Thursday at 18.09. It opened Friday's session a bit lower at 17.87 and even dipped to a low of 17.49 in the morning. This is significant. It shows that the initial reaction wasn't pure euphoria. There was doubt. The bears and short sellers likely saw that opening dip as an opportunity, a sign that the post-earnings pop from Wednesday was fading. But then the tide turned. From that 17.49 low, a wave of buying came in and didn't stop, pushing the stock all the way to a high of 20.67 before settling at 20.34. This wasn't retail panic buying. That sustained day-long climb from the low to the high suggests institutional interest. It suggests that fund managers and algorithms, after spending 48 hours dissecting Chime's earnings call, decided the company was, in fact, deeply undervalued. And what did that earnings report show? It was, by all accounts, a blowout. This wasn't just a mild beat. This was a narrative-changing event. Chime reported revenue growth of 29% year over year. In this economic environment, in a sector that has been crushed, 29% growth is a major signal. They announced they now have 9.1 million active members, a 21% jump from the previous year, and a sequential increase of 400,000 in just one quarter. This wasn't just idle growth. It translated to the bottom line. The company reported a surprise earnings per share of 15 cents, beating analyst expectations. And its adjusted EBITDA margin improved by 9 percentage points, hitting a positive 5%. To top it all off, management raised their guidance for the fourth quarter and the full year. This performance is made even more impressive when you set it against the backdrop of the broader fintech space. The fintech IPO index, a basket of Chime's peers, was down 1.6% this week. The whole sector is struggling with higher interest rates, slowing consumer spending, and a brutal funding winter. And yet, Chime defied its sector, demonstrating strong member growth and, critically, a clear path to real, sustainable profitability. This 12.44% surge on Friday was the market's "oh wait" moment. To understand why this is such a shock, you have to understand the expectation that was baked into this stock. Chime was the titan of the private markets. Back in 2021, it raised funding at a staggering $25 billion valuation. It was the undisputed king of the neobanks, the company that was going to end traditional banking. The expectation was for a blockbuster IPO that would mint new billionaires. But the market turned. The fintech bubble burst. Chime was forced to delay its IPO, and when it finally did come to market in June of 2025, it was at a fraction of that price. It went public at an $11.6 billion valuation, a 54% haircut from its private peak. From the very first day, it was branded as a broken IPO. That narrative stuck. As the stock's 52-week range shows, the market has had no faith. The high of 44.94 seems like a distant memory. The stock bled out, falling all the way down to 16.17. For most of this year, the stock has been down nearly 50%. This relentless slide reinforced the bear case and invited a huge amount of short seller interest. And that's the real battle that's happening right now. This stock is a war zone between a powerful short thesis and a new, data-driven bull case. The short sellers have a story that, until this week, was very easy to believe. Their primary argument is that Chime's entire business model is a house of cards. Chime isn't a bank. It's a technology layer that partners with the Bancorp Bank and Stride Bank. Its main source of revenue, its lifeblood, is interchange fees. Every time a Chime member swipes their debit card, Chime gets a small cut of the transaction fee paid by the merchant. The short thesis is built on the existential risk to that revenue stream. There's a huge regulatory cloud in the form of a potential Durbin 2.0 that could see the government step in and cap those debit card interchange fees. If that happens, Chime's revenue model could be slashed overnight. Shorts are betting on this regulatory hammer falling. Their second argument is valuation. Even after the crash, at its current $7.56 billion market cap, the stock trades at a P/S ratio of 3.6. The industry average is closer to 2.4. The shorts argue this premium is insane for a company that isn't fully GAAP profitable and has such a massive single point of failure in its business model. They see the Q3 profit as a temporary blip, a result of cost-cutting that isn't sustainable. What's your take on this? Is Chime's 3.7 times PS ratio still too high, or is the 29% growth rate a bargain? Comment below. This short thesis is what investors need to be aware of. If you are looking at Chime, you must understand how to track this. The first thing you need to do is look up the latest short interest as a percentage of the float. This number tells you exactly how many shares are being borrowed by institutions to bet against the stock. If that number is high, say over 20 or 30%, it means you are in a crowded trade. The second thing you must watch is the cost to borrow. This is the interest rate shorts have to pay to borrow the shares. If that rate spikes, it means shares are becoming scarce and the shorts are feeling pressure. Finally, you can look at the official fails to deliver data from the SEC. While complex, spikes in FTDs can sometimes indicate stress in the system. The shorts are looking at the 52-week high of 44.94 and seeing a long way down. But the bulls, emboldened by this week's earnings report, are looking at the 52-week low of 16.17 and seeing a concrete bottom. And this Q3 report is the bull's primary weapon. It directly attacks every single part of the short thesis. Let's start with profitability. The shorts called it a blip. But on the earnings call, management detailed the successful migration to their new proprietary platform, Chime Core. This isn't just a buzzword. This is a structural change. By owning more of its own tech stack, Chime reduces its reliance on third-party vendors, which directly improves its operational efficiency and margins. This suggests the Q3 profitability isn't an anomaly. It's the new baseline. Next, the growth. The shorts see a saturated market. The bulls see the 9.1 million active members and, more importantly, the 400,000 new ones who joined last quarter as proof of durable market leadership. Chime's marketing is clearly working. J.D. Power reported that in the third quarter, more people opened a checking account at Chime than at any other U.S. company. Their target market, the 200 million Americans earning under $100,000 a year, is a massive demographic that traditional banks have often overcharged and underserved. Chime is winning them over. Finally, the one-trick pony argument about interchange fees. This is the most serious risk, but Chime is already working to diffuse it. The earnings call highlighted a new product, MyPay, which is already on a $350 million annual run rate. This is critical. It proves Chime is not just a debit card. It proves they can cross-sell new fee-generating products to their 9.1 million members. They're building a platform, not just a product. This diversification is the single most important counter-argument to the regulatory risk. You can see this debate playing out on social media and forums. It's a stark divide. You have one group of investors looking at the high short interest and screaming manipulation, believing the stock is being held down. You have another group pointing to the high valuation and regulatory risk, claiming the company is still a house of cards. The truth, as Friday's 12.44% move shows, is that the facts on the ground have changed and the house of cards narrative just took a major hit. This brings us to the future outlook. What happens next? The battle lines are drawn. For the bull case, the next major catalyst is the fourth quarter earnings report. Management raised guidance. If they beat those raised expectations, it will confirm that Q3 was not a fluke and that the new profitable growth story is real. If that happens, the shorts will be forced to cover, and we could see a rapid repricing of the stock, likely to push it to retest the mid-20s and beyond. Another huge catalyst would be any form of regulatory clarity on interchange fees. Right now, the threat is the problem. If legislation is proposed and it's either weaker than feared, or if it fails entirely, that uncertainty vanishes and the stock's single biggest risk is removed. For the bear case, the risks are just as clear. The number one risk is that the Durbin 2.0 hammer does fall. If the government passes a harsh cap on debit interchange fees, Chime's revenue will be directly impacted and the stock will fall. Period. No amount of growth can offset that. The second risk is macroeconomic. Chime's core customer base is by definition more vulnerable to an economic downturn. While they said they see no signs of unemployment pressure on their members, if a recession deepens, that could change. Less spending means less interchange fees and higher credit losses on products like their SpotMe overdraft. This is the key battle. Do you believe the government will step in